inflation, and then why foreclosures 2008 versus now, and then iBuyers in that foreclosure process. So if we get into specific slides in each, I think that we, all of us working in the market, can show very clearly in our daily lives that this market is something like we have not seen, and I've been in the industry for over 20 years. So I think everybody's mindset goes back to '08. They go back to the crash. That's the thing that I think that we're hearing a lot, and I think that you have to be able to define how this market is different, but then also in ways that the market is drastically different from what we've seen before, and especially for a lot of agents that are newer. So we're going to take those and break them down one by one. So the way we kind of do this, Preston and I work well together in the fact that he is 100% a data nerd. That's his thing. He's good at it. And the way he presents data is different than the way I present data. So let's get this on. So what we're going to try to do is we're going to go over data, and then we're going to go over how I would dumb that down for an agent. So, because again, oftentimes I think that we tend to talk on such a different level, and we assume that our clients understand that, and they don't. So we're talking them in a totally different language than what they're understanding. So when we do this together, I like that he's going to go over data, but if you're hearing this and you're not oh gosh, I cannot present it that way, don't worry about it, because we're going to try to cover how that's relative and how to break that down for other agents or for other clients.
Preston, you want to explain to us why you came up with a title like that?
I mean, just in general, the dynamics of the market has never happened before. And it's a combination of a handful of things.
Is that okay?
Yeah, I think so. It's a combination of a handful of things. The most important thing being that there isn't false demand right now. There may have been demand for homes at a higher price before because it was so cheap to borrow money. But the demand for the house itself is still actually extremely strong. So in 2008, in 2005 and 2006, for 2 consecutive years, we saw home values going up while rental prices went down. And you don't even have to know real estate or be good at numbers to know that that's very, very, very bad sign. There's no way that prices should go up while rents go down. And right now, essentially what we have is prices going down and rents going up. So when people always say, oh, was it gonna be like 2008? I mean, yeah, prices are probably gonna go down a little bit more, but it's literally the exact polar opposite of that. And we're gonna go and explain exactly why 2008 can't happen statistically. But I mean, that's the fear that I get from most buyers when I first talk to them.
Overall, that's what you're dealing with, right? Is fear. Would you agree? Fear. The image of somebody who's afraid, you picture them, they're frozen, they cripple, right? They don't do anything. So I think finding out their specific fears and addressing their fears, that's what we're going to try to help you do. And like I said, smaller class, so take advantage of that, because sometimes we do bigger classes and we can't get to everybody's questions. But if we start with the listing rate, right?
What are you seeing out there in listings right now? And I think Preston is, how is it best for the agents in the room? How can they best explain it to maybe the random person, not someone who's a referral, the random person that they meet at a restaurant or some kind of event? How would we explain something like this is something we've never seen before?
Yeah, so
listings right now, just so you catch up real quick. We're just talking about, we're going to go through all the bullet points, and we're going to talk about the data, and we're going to kind of break that up. So right now we're on listings. Awesome, thank you.
So typically, I kind of just as a really quick explanation that gets them to engage is before the last 5 years, the most valuable thing the average person owned was their house, and today it's their mortgage. And they're like, what? That doesn't make any sense. But it draws them in, and it's accurate. It's genuinely accurate. So that's an intro that I would start with.
Explain that one a little bit more. I like the twist on it. Why is my mortgage worth so much more?
So we will never see these interest rates ever again. And this is leading into our first point of like new listings today. We had fewer new listings this September than in any September in the last 25 years. Like we don't have I can't even get data for like when we had fewer listings than this September. And it's because it does not make sense for most people that don't have to sell their home to sell their mortgage. They might want to sell their home, but it doesn't make a lot of sense financially to sell their mortgage.
So if the mortgage is the valuable thing, how do we put that to make money for someone? That's what the question you're going to have to help your clients understand. Because their fear is, I don't want to sell and buy at a much higher rate. Problem, right? Fear. How do you answer that for them? The answer is, you're looking at it all wrong. You have an opportunity that most do not. Because if you were an investor trying to get into the investment market, you're going to be paying 25% down and your rates are going to be 7s to 8s. But you have a rate at 2.5, 3.5, whatever it is. You now can become a real estate investor and take all the advantages of that low rate and keep that asset while somebody is paying that mortgage, and you're turning a profit on it because rates are doing what? They're increasing. But also because of those rates where we're seeing them hit the investors hard as well, not as many people are buying investment properties. You have an opportunity to take at a very low rate and become a real estate investor. Now go buy another home, and then their next concern is the rate. Well, we can answer that because we've got programs for that. We'll get into that in like the next segment, but specifically when Preston talks about the listings coming to market, that is validating, and you need to be able to like explain this to your clients, like, listen, not a lot of people are wanting to sell. Here's the proof. So,
yeah. I mean, most people's fear, because like I come from the investment side, is what I primarily did the first like 4 years I was in real estate. People's fear in their first investment is like, I don't want to lose money. It's scary. I don't know. If you bought your house more than a year ago and you're making it a rental, you cannot lose. Like if you're at 2.75 and you still have 10, 20% equity, you cannot lose. I don't care what your house is, it's going to cash flow. And rents are about to go up a lot, which we're going to explain why. Like rents are about to become a huge problem.
So go ahead and go into the listing slide. So one of the things we really like to do, clients, you can give them data and facts, but you can back it up with a simple slide. Now, the thing is, this slide looks overwhelming, right? But he's going to show you how to break that down. You don't want to give them so much that they're lost, but you want to be able to explain things to them, and for certain clients, they're going to want to see that. So that's where graphs come to play, and they're really helpful.
So usually what I'll do is I'll just show them like, this is how many listings we had in September. I'll break on this all up. So I'll tell them that we had fewer new listings in September than any other September in 25 years. So you don't actually have to go through every single year with them. You can just show them when I add every year from 2001 till 2022. We are at 7,562 new listings this September, and here are you all the way up. And what are the years we're afraid of? We're afraid of 2008, 12,391. We're afraid of 2006 for people that know what happened, because 2008 here didn't happen in 2008, it happened in 2006. We're at 12,532. And in 2005, which is where we saw our market tip, we had 13,000 new listings come on market in September. So
it's
I
going
can
the opposite direction.
It's going down. It's going the opposite. During those years, new listings was exponentially increasing, and now it's literally doing the exact opposite in 2008. Because people have interest rates they shouldn't sell, and they inherently know that.
So the challenge of, I don't want to sell, you give them an opportunity to make money on that good investment and become a real estate investor, right? Like that's a definite benefit. Because not only are you going to make money monthly that you can apply towards your new mortgage, but you're going to have the opportunity to have a seller buy down your rate and do a 2-1 buy down. Like we're putting a lot of people into 2-1s right now. Not just your traditional 2-1, so the 2-1s that actually hold money in your escrow account with the servicer and can pay for your refinance if rates go down. If they don't and you have a rate in the 5s, you're still in a good spot.
Does everybody in the room know what a 2-in-1 buy down is? Everybody's good, so good.
And then what she's talking about is the average 2-1 buy down costs 2.2 points, so 2.2% of purchase price. So they're saying that if you refinance, like everybody says, oh, the economy's going to crash and interest rates will be lower next year, that's fine. If you only use half of that money, so 1.1 of the 2.2%, you get that 1.1% that you didn't use back when you refinance. So if you refinance, I did the math, it's like within 14 months, it's free to refinance.
Now, you have to check with your lender because it is important. Not all lenders have that reserve account sit there. Some of them you buy it and you're done. But there are lenders that have that where it sits there and you can use that money to refinance. So then you're facing their fear of rates are not high. So we're seeing rates in the 5s with those buy downs. So if you're looking at a rate, now remember that's your permanent rate. So if your permanent rate's 5.8, 5.5, whatever it is, your first 2 years are lower. So if it's a 5.8, your first year on that buy down is 3.8, second year is 4.8, then into that permanent is 5.8. But you have to know those. I'm not a lender, but I know enough to get them to understand to calculate that. But the data is showing us that people are afraid to list. Why? Because they don't have to. So you have to show them opportunity. Is there a lot of deals out there? Can we agree that there's killer bargains out there right now as buyer's agents? All of a sudden those listing agents that were like, I don't know you, take your call. Hi, you showed my house? Oh, you do care. The mood had changed, right? Like significantly we feel it. So buyers that couldn't get anything done today are getting everything done. But you have to know that people are not listing to know what their fear, like it reads you into some of their fear. Their fear is, I'm going to lose my tail if I sell this mortgage. But where do people really make money? I mean, anybody that has wealth, ask them if they're an investor. I'm going to tell you all of them will say yes. I don't know any one of my clients that makes, like money, like flying his plane in to see property at a time. Like I can countless clients that do that. And I'm like, oh, it didn't matter what he did for a living. The fact that he has 300 plus properties and he has RV, all these people, they own real estate. So everyone, do you understand this slide? I mean, it's like crazy, but you see
it
how
looks crazy, but like in reality, most of the time what I do is I just show people, I consider 2014 to 2018 normal years because they were normal years. And then I show them, so even if we did like 2014 through 2016 and then just the years that everybody's scared of, which should be 2005 through 2007. You don't have to show them as many data points. I just use that for effect. Like we're just completely opposite.
everyone good on that? I know that graph is kind of crazy.
It's the best graph they have.
We have, yeah, no, but I'm saying like I'm trying to play devil's advocate here, right? He and I do this all the time, but do you understand, like the average agent would see this and not know what to say to that. So if you have a basic understanding, you can dumb that down and explain it to your clients so that they understand the opportunity that exists. So let's see.
Current inventory.
Current inventory, that's what we just covered, right?
No. So this is current inventory, this is active listings, excluding what's under contract. So this is obviously what we all felt in the last 6 months. In reality, this is what the news is talking about. The inventory is up 400% and this and that. Foreclosure is up 300%. Well, yeah, if it was 0.1% a year ago and now it's 0.3, that's an increase of 300%. But it was like 40% in 2008. You're trying to compare this to 2008. So our current inventory levels, and this is for Maricopa, so not just for Phoenix, but it's a good indicator, is 20,875. And like I said, I always compare it to normal years, 16, 17, 18. So you see us right there at 2022 at 20,800. We're still less than 2016, 15, and 14 as far as total inventory, and this doesn't adjust for population. So we're growing at about 75 to 100,000 people per year. That's a ton of people, about for every 4 people that move here, you need 1 more house at least. Our total inventory right now is actually still kind of low for where it should be.
But people that are comparing it, again, go back to what their fear is the crash.
Yeah.
You have to take them back to data of the crash because they don't remember. It's just like if you ask somebody today that got a really good rate when they refinance what their rate is, 2.4, they got like a 3.5, right? Like they don't, it's that perception of what they think they remember. If you take them back to data, you can show them what's actually happening. Because you have to be able to show the consumer what our market is actually doing, not what people are talking about. The other thing is, do you guys know where a big portion of our listings are coming from right now? Like, who do you think is a big percentage of listings? Do you think it's a mom and pop? No, it's institutional investors. 60%?
Yeah, 60% of all the inventory gains were iBuyers and institutional investors that were over leveraged, and they just were like, oh no, the price dropped 5%, we'll become insolvent basically.
Who was all those iBuyers, or where were those iBuyers when we were out there with regular buyers? We all went up against them. They didn't have a problem. 50 grand over, they were cash, they didn't care, right? We were up against them in the reverse. But 60% of our listings came from them because they got scared. And they realized that they over leveraged. It's interesting to know that though, because when you're talking to your client and they're not an institutional investor, you have to explain to them where this inventory is coming from. With that said, look up some of these investor properties. You're getting them for like 50, 75, 100,000. I've seen less than they paid for it. They bought too much, they freaked out, and they're dumping their properties.
So let me ask you this for both of you: is take a data commercial for a second. Is if you're talking to the layman consumer that's just out there that goes, I'm just going to wait because I know it's 2008 all over again. How do we talk to them while not overloading them with data? Like we're in a room of professionals, and the data can be a little overwhelming, right? So how do we talk to them in basics of saying, well, no, you don't want to go, well, no, it's not, because then you sound like you have commission breath and you're just trying to get a deal.
I would never say no, it's not.
Okay.
We never do that. That's not something I even train any of my agents to. The first thing I do is ask them, well, what do you mean? What do you mean it's 2008? Like, what are you referring to? I'm going to get them to tell me what their specific fear is. Because to make the assumption that they mean that the market's crashing because there's not enough listings, or do you know what I'm saying? Like, I never assume. I'm going to ask somebody a question. So if any of you guys, we can like roll through that. Have any of you guys had a client say, I'm afraid that the market's going to crash because of X? Have any of you asked? Like it's really eye-opening though when you get into asking somebody specifics versus assuming you know what they're afraid of. Because somebody who tells me they're afraid the market's going to crash, I have to know what they're referring to. What are you, like why? What specifically? So I know you've got some of that, we can role play through that, because what I'm trying to do is find out what their specific issue is. I never want to assume I know your issue. So if you're telling me you're afraid, I would say, well, what specifically, when you're referring to 08, what are you referring to?
Well, actually, my father lost his house. I watched my parents lose their house at the time, and I'm a first-time home buyer, and I'm worried about getting into buying something that I could have the same thing happen to me.
Okay. So, now pay attention. Did you guys notice I paused? I was just talking with him about this. I don't pause because I don't have an answer already in my head. I pause because if you sound like you already have the answer formatted, you sound scripted. Being scripted and sounding scripted are two different things. Do not sound scripted because you become a salesman. And salespeople scare people. Think of any sales experience you have, okay? So I'm going to go, do you know the specifics around what happened? Like, do you know if your parents, did they buy it? Like, do you know what happened?
No, I was
why they
super
lost
hard
it?
time. I was 17 at the time, and I was we had to go rent at a house for 2 years because we lost everything. I had a really nice car. My parents had a nice car. We lost all that, and I'm just terrified that's going to happen.
Okay. So I don't want to assume I know what happened with your parents. I can tell you across the board, because I was in the industry at the time, a lot of people were over leveraged in their properties because we had artificially inflated property values. In other words, a lot of cash people were driving up prices, but at the same time, there were loans being written that should have never been written. So a lot of people were getting into loans that they should have never gotten into, for the lack of better explaining. Like, they got a loan based on, I make this much money, and they didn't make that much money. There were loans out there that were negatively amortized. So when you're making your payment, you're not even touching what you owe on the home. So over leveraged, a lot of bad loans. But specifically, we're trying to avoid you feeling like you're going to lose that asset, where you're going to lose your house or lose the ability to cover your house, correct?
Yeah, I don't even know if I make enough to buy what I want, and if I do, why don't I just wait until it goes down to the bottom, and then maybe I can get it there at a good deal.
So when we talk about the bottom, that's also something interesting, because you have to analyze pricing and what's happened in the last, 2 years even, to know kind of what's causing it to feel like prices are dropping. But the biggest thing I want to do with you is I want to get to where, what's affordable to you, right? What's that payment look like? And then we can match up a program to that. And then we can match that up to a price point, and I can show you what's available on that price point. Now, if it's affordable and everything works, then we know you can afford what you're buying, and we're not putting you on a loan that's going to put you upside down, because we don't even write those loans anymore. They're not allowed.
Okay.
Does that make sense? Okay, so I'm just going to get them to see the opportunity at first. Now, the next concern that you may hear from a first-time buyer is the rate, right? Like, people are all talking about rates. Do you think people really buy based on the rate? What do people buy on?
Monthly payment.
Right?
Yeah.
I mean, we're all monthly payment people. I didn't buy my mortgage and go, cool, here's my, here's my cash. Like, that's just not how most people buy. If they have cash, that's great. We don't even have to worry about the rates. But most people are going to get a loan, and what they're buying on is their monthly payment. So there again, you have to have a match for that. You have to have a match for that program. There's so many programs out there. We just closed one a couple weeks ago. The initial rate was 2875, 3875, and 4875 for the permanent. And the money sits there and offsets that payment for those 2 years. And if the rates get to 4.5, cool, we'll refi, because that's going to pay for it. If they don't, and they're at 5.5, like historically normal 5 to 6, cool. You got a really good deal. I mean, you're right in that normal range. You see what I'm saying? So, go ahead. Are you going to bring up a chart?
One thing that I'm going to say in that whole interaction with his parents having to rent a house instead of keeping their current house, I wouldn't say it like this, but they got to be able to rent another house. There was a reason that they financially couldn't pay for their mortgage, and that was because it was at an extremely high interest rate when prices started dropping, and the rental rates were considerably lower. So we'll talk about that more in depth, but statistically, it's the exact opposite of that now. People can't sell it or default on their mortgage because the rent's so high compared to what they're paying. It makes bad financial sense to do so. The other thing that we talk about is days of inventory, which I'm sure everybody has a general understanding. That's just how long would it take to sell all active listings today if no new listings came on market. So right now we're at 79.4 days of inventory. When you're comparing to those normal years, 14, 15, 16, we're still extremely low. What's most interesting is, remember, this is what the news is talking about. This is what we're feeling. This is what all the people are freaking out over. But in reality, when you compare it to 2006, 7, 8, you look at, we're at 79 days. They were at 222 in 2006, 355, 356. They got as high as 412 days of inventory compared to our 70, which is just further shows demand's down, fewer transactions are occurring, but so few people are listing their house compared to what should be. All of this stuff is staying under what we should be at. We should have more days of inventory. We should have more total inventory than we do now. We just can't. It's just not coming from anywhere.
Not bad.
She talked a lot about interest rates. We're going to talk about interest rates just as far as like interest rates now versus like historical. This is just since 1990 because most people can wrap their brain around 1990, even if it was like first time home buyer. You see where we're at right now is actually like pretty normal over the last 30, 40 years. I don't think interest rates will always be 7.5%, 7%, but I can tell you for sure that like unless something really, really bad happens, they're never going to be 2% again. So historically, people were able to buy homes perfectly fine at 7%. We've just conditioned them to think that it's not a good idea to buy a house at 7%. And it's not necessarily that people can't afford them; they just don't want to. They were just for 10 years we just explained to people that 4% is normal when it's not, and you can still qualify for a very good house and pay that mortgage. People just don't want to.
How are you explaining for a person that bought a house in February, March of this year, so it's still dealing with the same, and the rates have changed considerably. How are you explaining to someone that maybe just knows that instead of not 08, they just know 2022, the difference in what those two markets were compared to no inventory, so on, and now what we have, just 7 months, 6 months later?
Like how do I explain to somebody that bought their house 6 months ago?
Yeah, for
why
someone
not to be scared?
or a seller that goes, hey, maybe I should have sold in September or March, or maybe I hold out and see if it comes back around, or there's a couple different things going on there, right? Is they're expecting that number from back in March, April, May that they're not going to get now, but they're also on the other side, the buyers who couldn't get a house, overpaid for the house, but got the rate they're wanting. Now they're paying more on the rate, but are you saying
So
things are on sale?
there's deals to be had that we could not get in the beginning of this year. So at our lowest, we were about 3,800, right, active listings at our all-time low. When you have that issue, you're overpaying for properties, you're bidding, you're fighting, you're going after each other to get that house. Now, we have a decent amount of inventory, still a little low, but a decent amount of inventory. But because of that, sellers are willing to play ball now. So we can get the seller to cover all of your closing costs, their buy down. Oh, and by the way, they're still gonna make repairs. How cool is that? Because we weren't seeing those. And they don't wanna live in them for free for 6 months. All of the things that we could not get a buyer to even, touch, like price points we hadn't seen either. Those are back, low 300s, like mid 300s. One of my agents has one in the 2s. I'm like, where? Right? But that's the reality, is we're seeing things we did not see happen. So even though you have the trade-off of a bit higher rate, you're not up against multiple offers. How many people, and I ask my clients this, how many people do you think are thinking the exact same thing you are? How many people do you think are like, I'm gonna wait until rates are better? Probably a lot, right? But here's the thing. If we could get you into a buy down, and if rates get better, you're already in the house. If they don't, you have a good rate, right? But if we can get you into a house now, and if rates get great at 4s, 5s, whatever, and everybody that's waiting now buys, how much competition are you gonna be up against? I'm not gonna be able to negotiate the things that I can right now today if rates adjust to like the 4s and 5s again. So you have to be able to show them right now today what you can get done that even in March you couldn't get done. I mean, if you would have called a listing agent at the beginning of the year and said, hey, I'm coming in 20 grand under and I want 3%, how many of you would have not heard click? Or a laugh, right? Like, you can, what? Good luck with that, right? So you have to show them the things that we can get done today. And it's all over. I mean, go into some, if you don't have enough, like if you, I don't know, if you're not producing enough transactions personally to pull like 5 out of your hat, go into some closed files and pull. It shows you the concessions. Go in there and pull, like, hey, if you're at my home group, go into my home groups. The last 5 deals that I saw crazy at my company, this is what they were. It is, you're at the company. use that data of other agents in the company, but show them a couple of deals that were insane that are happening right now. Give them reference to understand what they can get done. And the people that bought, when we were all banging the drum that it's historically low and people were like, I'm so frustrated, but the people that stuck there, hindsight's 20/20, they're real thrilled with their rate. But now you have some equity and you have a killer rate, so make some money there too. Don't just sit on that.
Move to the next item is I know for you, Preston, and for all of us, right now we're in voting season, right? So we're a month out from that, and all you hear is inflation, 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 right? This is killing us, or it's not as bad as you think. It kind of depends whose mouth it's coming out of, right? How do we offset depreciation with inflation the way you see it?
Yeah, so most of the people that I have now that are actively buying are very financially stable, very successful older people, which is kind of interesting because you would think oh, the old dogs would be the ones that are just hoarding. Mr. Monopoly's hoarding his coins in his closet and he's not buying. They're the ones that are like, ooh, I'm starting to see deals. My flippers, he calls me every day. He's like, I need 2 more. I need it right now. So smart, savvy people are buying real estate with a purpose. There's no asset that I'm aware of right now that's not losing money. So if inflation is 8.7%, whatever money you have in the bank account is going down 8.7% per year. I was just running we've had some good days in the stock market just recently, but the S&P is down 22% since January, not even from a year ago. The Dow is down 17%, and we're still up 6% year over year in real estate prices. And a lot of these people are also buying income-producing properties, whether they're flips, short-term rentals, long-term rentals. So they're making a return on that while also not having their money in the bank turn to nothing. Because it only takes, I think it's 11 years at 8.7% for it to drop by 50%. So when you look at real estate, they're buying it understanding that prices might go down 5 or 10%, which they might, but compared to everything else, that's way less than buying stocks a year ago or a car. People were offering me more than I paid for my car 2 years after I bought. Not happening now, I can tell you that for sure. So smart people are finding reasons to put money in real estate, which is something that when I see, I'm like, that makes sense.
And that's, I think, for me, this is why we work well together. He pulls all that out and I'm like, yep, I get it, but that's not my level, right? So for me, I'm like, what other investment are you putting your money into that's going to return positively? And there's not many people that can say, oh, I got this, right? And if they do, it's usually real estate driven somewhere. I'm buying this or I have that. That's where I'm hearing the money being made. So you have to ask them if they're like, well, this chair just keeps getting lower. I feel like I'm getting to be a midget over here. And I never sit down, so it's nice on these small classes. Thank you. So you have to ask them that, though. Again, don't make the assumption that you're speaking the same language. It's one of the things I really push in my trainings is you think you know what someone's saying, but until you dig deeper, you don't know. You need to ask more, talk less, and then get the solution. So there's no other investments that I know of that are turning a positive. Now if we play devil's advocate like we were earlier today, which I love, people are going, oh my God, prices are dropping. I don't know if any of you traveled outside of Phoenix and talked to anybody who's like, oh, you're from Phoenix? Oh, you guys are getting hit hard with price reductions. I just went to a conference and I heard that a few times and I just chuckled because many of them were agents and I'm like, okay, what is your perception, right? What do you mean we're dropping the highest? We were the highest returning. If you take an average of 23% each year for the last 2 years, and now we're just normal of we did this earlier. What would you say historically in Arizona we've returned at annually, percentage-wise? 7? That's about spot on. But earlier when we did it, it was 8 to 12, 9 to 10, right? But historically, take it historically, not the last 2 years. if you say 7 to 8, you'd probably be in that ballpark, right, of where we've returned. So if I'm 23 and 23, and now I'm just normalizing, even if you reduce by 20 of those, I'm still up. And that's where you have to take them back to. Again, take them back to their property values. And the people I think we're most afraid to talk to are the ones that bought in the last 2 years. Why? Because they were the ones that were going 50 over, right? Now you're probably afraid to call them because you're like, I'm going to look like an idiot. No. You did what they needed to do to get into a house at a historically low rate. Remember when I kept saying, guys, this is historically low? Rates are 7.5. How good do you feel about your purchase? Cool. You still have equity there too. So if ever you thought about wanting to get as an investor, now's a really good time to consider it. You cannot shy away from those people because they still made a really good choice. We're just trading off now. You're getting all kinds of bargains we weren't getting, but they got low rates. Now you have high rates, but you're getting deals. But those high rates, I'd take that all day long. Give me a bargain, I'll gamble on my rate, and oh, you're gonna pay for me to refinance too? Cool, I'll take it. But you have to be able to explain that to them. Don't be the lender, but know enough to be able to explain it to that level, and then get them on the phone with the lender. And my lender is conditioned to talk about deals. That's what he talks about. The deals people are getting. Wow, holy cow, like I wasn't, did a lot of loans, this is an amazing deal. And then break it down to the payment. Of course he has to hit on the rate, but he doesn't go into it. Because most people are not even gonna, if they can afford it, they don't worry about it.
And then we're going to foreclosures, then there's
Rental
now.
rates. Did we talk about rental rates? Did we talk about rental rates?
It's not rental rates next. So foreclosures, he was talking about this hypothetical situation where his parents lost their house. So there are some similarities in that there was a lot of appreciation in 2008. There's a lot of appreciation leading into this. The biggest difference is that they went into a recession starting at 7.5% interest rates, and we started at an average of like 3%. So at that point, you could do a short sale and not pay your mortgage for 6 months or a year. I had this guy call me. He's like, dude, I haven't paid my mortgage in 7 years. What do I do? I was like, I'll probably try to short sell it. The bank was not happy when they found out. But you could not pay your mortgage for 6 months, short sell your house, and then go and rent the neighbor's house for $1,000 a month less than you were paying in your mortgage. Right now, it's going to cost you $1,000 a month more than your mortgage, and you got to have a short sale. So we just had unemployment. I don't know if you guys follow like the economy and like there's monthly reports and the Fed, rate raises, all this stuff I follow. But in the last unemployment report, it went down by 0.2%. So 0.2% of people fewer filed for unemployment than the month before. Unless we see unemployment increasing, like we did in 2008, that's when people can't pay their mortgage. That's when they can't pay their car. That's when all these bad actual economical things start happening. Right now, sellers are like, well, more of us are employed now, and I've got a 2.5 or 3% note, and it costs me $1,000 a month more to rent something else. Why would I short sell, right? In that case, the reason that they rented that house was because they couldn't pay their mortgage at the rate they were at, and they could pay for rent. Now people can pay their mortgage, and they can't pay for rent. So it's completely opposite of 2008, which is, again, why you see this in the numbers. Like, why do we have fewer listings now than at any point in the last 25 years? That's why.
So you see how that all is hand in hand? Like, do you see what we're taking with, and you don't have, you're gonna gauge your clients as far as, you're gonna gauge your clients as far as, first go with their concerns, answer their concerns, and then take them through whatever levels you need to show them the differences. Because if they're truly concerned about a crash, it is so easy to show them that we're not in that same process or in that same, trajectory to crash. So when you talk rental rates, touch on I want you guys to understand when we say that there's going to be a shortage of rentals, why would people even consider this? Because when you're talking to somebody saying, hey, you got into that home, was that your dream home? Most people know, right? They're going to be in their home a couple years, and then they're going to want to upgrade. but they can turn a profit and rent it out for more than they probably even imagined. So you do want to have somebody that's either a property manager you trust, run some numbers, or be really good at running them in the MLS. That's not my niche, so I have someone I trust that I get a number from. But you're going to have to, again, show them why are we saying rentals are going to be in short supply, right?
So, Arizona has the second lowest rental vacancy of any state in the country, behind only California, and we all know what rental prices are in California. I lived in LA for a year, and I was paying like some absurd amount for like a studio, and I was like right on the LAX runway, which was horrible. But we're pushing so many people that we're thinking about buying towards renting. Obviously, you guys know, like there's not nearly as many transactions occurring. People are looking at interest rates, their mortgage payments, and they're like, oh, I think I'll just rent for a year, right? 50% of potential buyers, 75, a significant portion of potential buyers are now renting. Now, that's fine, assuming we can create new rentals, because we're already at the second lowest vacancy rate in the country, right? So how do you create new rentals? Two ways. One, builders build new houses. Builders are not building new houses. I was just talking to D.R. Horton on when phase 3 was going to come out, because they have bigger lots in one of their communities, and she's like, we don't even talk about phase 3. Like, I don't know what you're talking about. Like that, when we see things turn around, we'll talk to you about releasing phase 3. The second thing is investors buying rental properties. And the problem is right now, I don't know if you guys have ever done a rental property sale, but if you try to have positive cash coming in for somebody that's financing a rental at 7.5%, it doesn't exist, right? So it was easy to finance at 2.5% and make a killer return on a rental, like the homeowners now that have 2.5% interest rates. But now the only people that can buy rental properties really that aren't like not wanting to have $800 a month in negative cash flow are cash investors, which is only like 20 to 30% of all investors, and people that can put significant amounts of money down. So we are like creating almost no new rentals. We're pushing like 75% of the buying pool towards renting, and builders just haven't told everybody that they're just not going to build anything for the next 6 months or a year, at least new projects. They're going to build what they've already put roads and pipes and electrical into, but all the future phases, it's off the books for now. So we're going to go from the second lowest vacancy rate to pushing everybody, not everybody, but essentially everyone towards renting, and we're also not creating any new rentals. So it's going to be a problem. It's going to be a really big problem.
So again, ease that problem with showing them they can become an investor. And you talk to somebody who's like in their first, maybe even second home, and kind of youngish. You think that they ever thought they'd be a real estate investor at that age? No. But if you can show them how to do that, you're going to help ease that, and they're going to get into a property. We can buy that rate down. All of the things, right? They get to upgrade. But when you talk about like the rental problem, and they tell you that they're going to rent, that blows my mind. Literally, what I'll say to someone is, "You're worried about paying 5% or 6% on the rate we can get you to, but you're going to give 100% of your money to somebody for nothing. You get no return. You're going to throw away. How much are you going to pay on rent? I'm like, $2,000. You're going to give somebody $24,000 in a year. So you're literally worried about 5 or 6%, but you're going to give 100% of your money to somebody for nothing to live in a house when you could be paying that to yourself and living in a house." And you're gaining equity, plus you're paying that money to yourself. Tell me how that works. And again, you have to know your client, but if you say it to them like that, how is that? I mean, I'm not a financial planner, but that doesn't sound like good planning to me. So you have to, again, break that down for them. But sometimes if they're like, oh, I'm going to sign a 2-year lease, I would break in and be like, okay, so you're going to spend $48,000 to somebody? Whoa. So those are the things. And if you take the average of 7% increase in our property, you're not only gaining 7%, you break that down to a dollar amount based on the price, but you're putting that $48,000 into your hand. I think you have to still, at some point, open people's eyes to understanding, if you can buy, why would you not buy? Why would you give all of your money? just to throw it away.
So Preston, let me ask you this, with the investors that you deal with, and your family's been in the industry a long time, you've seen the ebbs and flows from the sidelines and in the game. If someone had, I don't know, 200,000 or 300,000 or I don't know, 500,000 in equity, or they were all they've cashed out and they've paid off their loan, let's say at 500 grand, what advice would you give them to doing what you're talking about without tying up, or should they take that money, put it into a new house or put it into a couple houses, or what would you suggest that they do?
Yeah, I would say for sure pull out some of the equity. I mean, when you look at real estate investing, like it's really over like 10, 20, 30 years. So if anybody has a house that's paid off or a house at an interest rate before the last 6 months, like it's such a bad financial decision for them not to become a real estate investor at this point. Because they can rent out the house they're in and they can buy something that they can afford comfortably and live in that house themselves, and the difference between the rental rates and their interest rate is going to more than pay for the difference between today's interest rates and 6 months ago's interest rates. You know, $1,000, $2,000 a month in some of these houses. So it just does not make good financial sense as long as you're looking over 10, 20, 30 years. Like my dad's been doing real estate for 55 years. Back in the day, he used to be able to do things you can't do now, which was assume loans without qualifying, which they changed, I think, in 1989. So he assumed 300 VA loans in the 70s, and just went to the bank. He was like, this guy's going to sell me this house. The bank's like, okay, here's a piece of paper. He signs it. Now it's your house. That's it. It's done. What's interesting is that during that time that he owned all those houses was like 20% inflation and crazy interest rates and up and down and like crazy stuff. You know, we had the oil and gas crisis. We've had all kinds of stuff. That whole time, like he knew, like this is 10, 20, 30 years out, like he's living very comfortably at this point. So as long as they have that perspective on investing, if you have your house paid off or an interest rate under 5%, if your plan is that very soon to turn that into an income producing property, then you have not talked to the right people.
You see the opportunity.
Good.
Yeah,
Good.
his dad is very, we brought him to our team, and it's crazy to hear perspective from somebody who's been in that long. Like, I feel like I'm a dinosaur. His dad was like, his perspective was so cool. I mean, we were all just kind of like hanging on every word, because I mean, you're talking to somebody who lived through, you know, what do you say, when rates aren't high right now. When rates hit 18, those were high. And I was like, Jesus. Like, but that's somebody who lived through it and sold through it. That's the key, is he sold through all of those markets, and he's still an agent, active producing agent. It was all because he had perspective on how to shift how his behavior is and what to do and what to talk about different.
That perspective, he opened the first real estate brokerage dedicated just to Chandler ever. So before that, it was just like the agents from Tempe would come down and like sell some houses in Chandler. That's that type of perspective where like they just, the ups and downs, and it's the same thing with my like very financially savvy buyers, experienced people. They like just do not care about the next 6 months or a year. Like all of their perspectives is way out. And it's so nice that what had occurred happened to where people that had no experience, like you cannot miss. Your interest rate is 30 to 40% of what it is today. They're going to adjust rental rates according to how much it costs to buy and finance a house, because that's how real estate works in the long term. That's like going back to like, you could probably go back to like 1960 and have your pick of stocks. Relative to today's prices is the same difference between today's interest rates versus 6 months ago. Like you don't even have to pick the right stocks. You just pick 10 of them, all be good by the time we hit 2022. You cannot miss if you have that low interest rate.
So I think we covered the bullets. I always like the end. I really like to like.
Yeah, with respect to everybody's time, what questions are there in the room? And there's a lot of information that's kind of been fire hosed at you. Data perspective and the rational perspective maybe a little bit. But what kind of questions?
That's why we work well together.
What kind of questions are there in the room that you guys have?
Yeah, and don't, I mean, guys, look, like anything, because here's the deal. Like, your time is valuable, so you sat here with us today, and you're facing different clients, and you're facing, and you know what I'm saying? So, like, really, get it out there. Like, this is your chance, because I think we do that a lot, where we sit around and come up with, you know, lots of questions and answers and stuff, so take advantage of this.
I
My name's Jack Hinkle. I'm with HomeSmart, and I'm in broker's class right now, and I got an email from Navy Title saying they were doing this. So everybody's looking at me like, who's this guy?
No, you're good. There's almost 4,000 agents here. We wouldn't know.
So I'm not with my own group. But I do have a question for you. So you were talking about if you own a house cash or if you got significant equity in that house, you should be buying another house and renting out that current house that you have. Are you talking about doing that with a HELOC, or how would you finance
you
that?
can go up to like 70% on a cash out refinance.
Or not even, that's a HELOC.
You're talking about
HELOC,
doing a
yeah, you
HELOC,
can
and
HELOC.
I keep my 2.6% interest
Yes,
rate on the
yeah,
house.
don't
That's
refinance
really
it, right, keep it.
Just pull a HELOC and go buy another house, go live in that one.
Yes.
Okay.
And when you're getting into HELOCs, it is so crucial to look for the right lenders that do them, because some of the HELOCs are substantially higher and their terms are bad, but there's others out there that are really pretty aggressive on their rates. So make sure, like, we did that with our dig into like who we thought had the best rates on HELOCs, because you want to have that solution for them. So again, before you go pitch this, don't pitch it without having enough data. Do some homework first on who you're going to refer them to for those HELOCs. Your traditional lender isn't going to be that person. The HELOCs are going to be like these lenders that you're going, weird name, you haven't heard of them, but find the ones that have the best and have those in your pocket ready. Like, look, I've done a ton of research on it. I looked at like 15 different, and these are the two that I found to be the best. Do your own homework, but these are the two, so that way you're giving them something to start with. Because if you tell someone to go get a HELOC, they're gonna, it took me a while, and I'm seasoned, right? So you want to give them a solution. When you're giving them, like, do this, you want to give them somebody to go to. But yeah, that's 100% what we're talking about, is capitalizing some of that equity. Now, remember, they may not have to touch that, because if I'm getting all my closing costs and my buy downs covered, and I can get into a 5% down, they may not need that equity out of the home. So I'd go back to like asking them and then giving a solution to them.
So that investment property would be at it wouldn't be an investment property, it would be a primary residence, so it would be at that
One that they're
lower
buying.
interest rate, the one that they're buying.
Yeah, the one they're buying, you're gonna buy as a primary, correct.
It depends on what they are. Like for VA people, it makes like so much sense. Without even the idea of like assuming another VA loan, like 0% down loans like that, where they don't have to refinance anything and they just convert it. The VA doesn't care if you're going to use your old house as a rental property. You still get to use the rest of your entitlement. So it depends on the client and what it is,
And I would ask, because again, a lot of people are stocking money into something that's not making them money right now. So maybe instead of doing that, they can come up with like a 5% down. So it just depends. But yeah, if they have a ton of equity and they're not afraid to take it out on a HELOC, there's so many ways to get there though.
Good question. Thanks for
Yeah, I love it.
Thanks for the email from Natalie. We appreciate it.
Yes. And it's always open to all brokerages. So I like smaller classes though, because sometimes bigger ones I can't even talk to everybody. So is there other things? Nothing? You guys are good?
So when's the next one of these? You're trying to have these?
Yeah, we were trying to have them once a month.
Okay.
And I love that going into the holidays, because every agent, like, I feel like it's a ghost town. Like trying to reach people. I'm on vacation. But we are going towards one a month. And we'll be shooting it out with you guys as well. So Navi will be promoting it, and we'll be pushing. We can change locations. I mean, we're not tied to here. We just did it here because it was easy, and I knew it's a big room, and you never know the crowd size. So we can do it at a different location. We've talked about that. But we are trying to shoot for one a month. And we're big on, like, if you guys have recommendations that you want to hear topics on, I like getting, because I think Kelly sends out, if you signed in, did she leave the sign-in sheet up there? If you sign in, Kelly will send out a survey, and so it asks you, like, if you have topics you want us to cover.
That's awesome. Do it right on time. It's 1:30. I appreciate the stage presence, and thank you everybody for coming. We appreciate it. And for you two with the drop of the knowledge today, that was awesome. Thank you.
Navi.
Thank you. Thank you.
Thank you guys.
Thank you. We did it on time. And we're around if you guys have other questions, so. Jonathan, will you let Kelly know we're done? Will you let Kelly know we're done on the